Bull market story still intact as Wall Street has largely avoided the seasonal weakness, as we were mentioning, of August and September, but a number of threats are looming, including, of course, the election 4 weeks away. Our next guest is looking past the headwinds and focusing on three tailwinds, including a dovish Fed, China's late stimulus push, and lots of cash on the sidelines. Let's bring in first CNBC contributor Tom Lee, co-founder and head of research with Fundstrat, and our very own Mike Santoli joining us as well. Tom, let me start with you. It was in April on this program that you said you thought the S&P 500 could close at 5,700, maybe even higher. Well, looky here. Look where it is today, right about 5,700. So the maybe higher part is still a part of your formula?
Yes, I think it's part of the formula because, bull markets are supported by strong fundamentals. And this is a case where not only has the economy survived extremely high interest rates, but the Fed is beginning to cut rates. And an economy that has sort of been languishing has been China. And now we have some stimulus and what looks like some bazooka policies that is supporting that region. And we have a lot of cash on the sidelines. So I think that this is a formula for stocks to do pretty well the next 3 to 12 months. And that's why we think that we would be well beyond 5,700 before year end.
Well, so Mike, Tom says tailwinds overpower headwinds here.
Yes, although I think you do have some offsets. And I think that even though the August and September, the advertised seasonal weakness didn't really show up in the terms of sustained downside, it did become a less rewarding market, right? You had more downside moves from that August 1st level than you had upside, at least during those 2 months. So I do think that reflects the fact that we have priced in a pretty decent scenario here. We're 21 times forward earnings on the S&P 500. I think a soft landing is pretty much what's underpinning that idea. That said, it's hard for the market to get into too much trouble when the Fed is easing into a resilient economy. And even though we're having to worry about maybe less Fed easing than we thought Thursday before we got this jobs report, I think that's a better formula. Economy holds up better. The only reason you'd worry about it is if you think the strong Friday jobs number was a head fake. And all of a sudden, it really was not representative of the economy being strong, and yet yields are higher, and yet oil's higher. We're benefiting from those things starting at very low points, under $70 crude, and then, 3.6 on the 10-year as a low recently. And so, therefore, the big violent vertical moves we've had in those areas have not really upended anything except maybe the housing stocks. But I do think, you have to be aware that we're 2 years into a bull market. That's often where it kind of flattens out and becomes a little bit less aggressive on the upside.
As our guest last week said, the third year is the hardest one often.
Has tended to be, yeah.
Tom, do you want to build on that and address what you should do with small caps here, why they've been so – actually, that's probably the one area we've seen the most weakness since the Fed hiked rates.
Yeah, small caps, they're within a few percentage points of an all-time high. And Mark Newton, our head of technical strategy, thinks we are still in an up move for small caps that just started recently. But yes, it's been disappointing. I think it's been especially disappointing because China and small caps historically are fairly highly correlated. And so we are seeing risk-on appetite increasing in some places. But I think it's just a matter of time. I think part of this is, between now and the next month, which is around Election Day, there's a lot for investors to digest. It's including oil prices, and the VIX is elevated. I think these are things that are hard for someone to say today, between now and early November, I want to be buying risk outright. So I think small caps still have good fundamentals. Earnings growth is accelerating. The median PE is 11 times, which is almost 7 turns lower than the S&P. So I think there's still the case to be made that small caps are starting a multi-year gain. It's just been very choppy.
As you look at oil, what would an interruption of Iranian oil supplies, which is really only 3%, as I understand it, of global output, what would an interruption of Iranian oil mean? Maybe not in economic terms, because it might not mean very much, but what it could mean psychologically to the market.
Well, markets don't like uncertainty, and oil is spiking not because of demand, but because of what you're pointing out, Tyler, the risk of a disruption. And, oil can move up quite a lot before it actually triggers the level of burden that causes a recession. That number is probably closer to $200 today. but it would be no fun for any consumer to see oil at 120 and gas prices more than double. So it's something that I think would be very painful for consumers just to see oil surge, and even if it's temporary.